Do you believe that climate change creates significant financial risks to corporations?
I'm sorry, I didn't hear the word in there.
Do you believe that climate change creates financial risk to corporations?
It's really what investors are basing their investment decisions. And what we found in public input is significant number of investors managing tens of trillions of dollars of assets believe that it's important to their investment decisions. That's the standard we're held to.
Well, let me maybe then sort of add a little color. In 2020, as you know, the CFTC said that climate change poses a major risk to the stability of the U.S. financial system. In 2021, FSOC said that climate change is an emerging threat. And recently, the IPCC said that within the range of possible temperature rises, global economic losses could amount to $23 trillion per year. Are these numbers material?
They're significant to the economy, but what's material is that investors in public companies are today making decisions based on climate risk disclosures, and we're trying to bring some consistency to that.
Is it your view that clear disclosures would help investors to hedge those risks?
That is certainly what our comment file, that we've had thousands of investors who have said that to us.
Okay. I'm assuming this is a yes. You're familiar with the term information asymmetry?
Yeah, yes, I am very much so.
Okay. There was a report from Nature Climate Change recently that said that real estate in the United States is estimated to be overvalued by $121 to $237 billion due to unpriced flood risk driven by climate change, with low-income households facing the greatest risk of losing home equity, as was the case in the 2007-2008 housing crisis. Can you speak to how your proposed rule would address that informational asymmetry between folks who are aware that they're overpriced and folks who are not?
I mentioned it about Chair Rayburn and President Roosevelt. They were trying to address information asymmetries, that the public didn't have full, fair, and truthful disclosures from companies accurately describing their risk. That's what we're doing here in this proposed climate risk, is so that the investing public better understands the risk when they buy or sell a security.
Okay, when I'm done here, I'm going to run to the science committee, so you'll forgive me if I dump into the science side here a little bit. There was an article in the Washington Post, I think it was just last week actually, that talked about the effect of climate change in coastal communities in the U.S., found that recent hurricanes Michael and Ian were both made much worse by warming oceans. Federal tide gauge data, this number was shocking. In Louisiana, the sea level is 8 inches higher than it was in 2006 when Hurricane Katrina hit. Just since 2006 is 8 inches higher. NOAA has said that they expect 2 feet of additional sea level rise on the Gulf Coast by 2050. So if you buy a home in Pensacola today, it'll be underwater before the mortgage is paid off. I could go on and on. There's data from First Street that there's more than 400,000 properties, more than a third in West Virginia, that are at risk of severe flooding. Is it logical to assume that purely profit-driven companies are going to seek to offload that risk onto less sophisticated players?
Well, public companies, which is the only thing we oversee is the public companies, manage their risk, and this has become an important risk, and it's a risk that investors want to understand how they're managing it, whether, as you say, they're defraying it or offloading it on others, or they're retaining it inside. And that's really, it's about disclosures of how they're managing that risk, like they manage other risks.
So I asked that question because we know, and the CFTC report actually acknowledged that they said that they have seen that insurers are offloading risk onto Fannie and Freddie disproportionately in flood-prone areas. Given that movement, and given your obligation to protect investors, is it safe to say that your mandate is to protect all investors, not just the sophisticated ones?
It is absolutely correct that it's all investors, whether it's the most sophisticated, the largest, and the smallest, but we're merit neutral, I just want to say. So it's a matter of disclosure-based, disclosing the risk and how those companies are managing those risks.
Well, obviously from my questions, I agree, and you you know, you had mentioned $130 trillion of global assets under management that are looking to get into ESG pieces. And as we sit here saying, should we be protecting all investors, or is that just woke? I'm glad to hear you keep pushing this, and I would just urge you, given your mandate at the SEC, to continue to push hard for a strong climate.
The gentleman's time is